So hello, what's up? I hope all of you are doing great. Welcome to another revision session in which we are going to revise the topic of group audit. Either you can call it group audit or you can call it an audit of consolidated financial statement. So first of all, they tell us the legal provisions about it, whether the consolidated financial statements are a compulsory thing. Answer is yes. Whenever an entity has a subsidiary, associate or joint venture, come on, whenever an entity has a subsidiary, associate or joint venture, they are required to prepare the CFS as per section 129 subsection 3. Second thing, sir, what are the provisions which will be applicable to the preparation, presentation and audit? These principles are the same which are applicable to a separate financial statement. That means you have to prepare the financial statement as per the schedule 3. You have to prepare them as per the accounting standards. In case you have an exemption, from the preparation of consolidated financial statement, still you need to give the disclosures of schedule 3. Now sir, comes the question, when will the entity not be required to prepare a CFS? In case three conditions are satisfied. What are the three conditions? Parent entity is okay, even the non-controlling interest, or you can say the other members, they are also okay with the entity not preparing the CFS. Okay, these two entities are okay, both the parent entity as well as the NCI are okay. That means it is a wholly or partially owned subsidiary. All its other members, that means the minority holders, they have been informed in writing, proof of delivery is available, and they have no objection to the entity not preparing its CFS. Even there is no general public. So no general public means it is neither a listed entity nor in the process of listing. And the third case is the parent entity. This entity's parent entity or the ultimate parent entity, they are preparing their CFS. So ultimately a CFS is prepared and is filed with the registrar as per the accounting standard. So these three conditions if satisfied, you are not required to prepare the CFS. Similarly, if there is an investment entity, sir, what is an investment entity? Like a mutual fund. Mutual fund also invests in some companies, shares and companies, yes sir. But whether they are doing it for some synergy purpose or just for the sake of investing, they are doing it just for the sake of investing. When they are doing it just for the sake of investing, India says no need to prepare the CFS. So again, who is an investment entity? Three conditions need to be satisfied. They are taking the money from the unit holders. They are taking the money from the people. For what? For providing investment management services. Then investing the money in the shares. How they are making money? They are making money from the capital appreciation. The shares value is growing. Or they are making the money through the dividend income, that is the investment income, or both. And the third point is they are measuring these shares. They are measuring these shares on a fair value basis. That means if there is an increase in the value, it is credited to PNL. If there is a decrease in the value, again it is debited to the PNL. That means they are valuing the shares on a fair value basis. So these 3 points you need to remember. Taking the money for investment management services, investing the money for capital appreciation and for investment income, or both, not for the purpose of trading. And the last point says very simple thing, measuring on a fair value basis. In case there is a parent of an investment entity, then in that case CFS has to be prepared unless that parent is also an investment entity. Now sir, there was a question in which you gained a control over a subsidiary and in the next year you sold that subsidiary. So we call it as a temporary control. So if there is a temporary control, or there is one more thing, operating under severe long-term fund transfer restriction. That means the subsidiary is not able to give dividend, it is not able to transfer the funds to the holding company. In such cases, in these two cases, the accounting standards allowed you an exemption from the preparation of CFS. But Ind AS 110 says you have to prepare the CFS. You have to prepare the CFS. We don't give you any exemption for temporary control. We don't give you any exemption for operating under severe LFTFR. So what is LFTFR? Long-term fund transfer restriction. We don't give you any exemption. If you got control, you got to consolidate. Come on. If you got control, you got to consolidate. That means the day you gain control over a subsidiary, your consolidation begins. And it continues till you lose the control. So this is what you need to write in the answer and your answer will be complete. Now comes the question, responsibility of parent. Who is responsible for the preparation of CFS? Sir, management of the parent entity. So what is their responsibility? First of all, identify who are the subsidiaries who are the associates, who are the joint ventures that will become a part of this consolidation. So identify all the components. Once you have identified all the components, get the information from them. Obtain accurate and complete financial information. Before you consolidate, make sure you do the consolidation adjustments. What are the two consolidation adjustment? Gap adjustment. Sir, what is a gap conversion? In case the subsidiaries financial statement are as per accounting standard, parents financial statement are as per Indian accounting standard, so that accounting standard to Ind AS conversion needs to be done. Similarly, if the subsidiaries accounting policies are different from the parent, harmonization of accounting policy needs to be done. So this is a 5-step process. Identify the component, obtain the information, do the adjustment. Two adjustments are gap conversion and harmonization of policies. And last 2 points generally you forget in FR, in audits, or what are they? Ind AS 24, Ind AS 108. Related party disclosure and segment reporting. Got it, sir. Then comes the auditor's objective. Very simple. The auditor objective is always to obtain a reasonable assurance, or you can say satisfaction. Satisfaction that the financial statements are prepared as per the FRF. Once you get the satisfaction, you can give your opinion about the true and fair view. Then you talk about two company audit section, 143.1, 143.3. Say with me, 143.1, 143.3, 143.1 inquiry, 143.3 reporting. And the last part, little ajeeb sa part, sir, what it says, it is a little antique part. I don't know why they have given. Validate the requirement of preparation of CFS. Is the entity actually required to prepare a CFS or not? Now we talk about materiality. Sir, in case of materiality, you need to compute materiality first of all for the CFS as a whole. You compute the materiality for the consolidated financial statement. This big materiality you use for two purposes. First of all, for auditing the consolidation adjustments, whether it is permanent or current. Second thing, to determine what are the material components. To determine what are the material components that you need to focus as an auditor. Whoever are the material components, now for each of these components, you need to compute a separate materiality. Now for each of these components, you need to compute a separate materiality. So call the component auditor. Hello, component auditor. I have calculated your materiality. Do the audit. Okay. Arre, wait. Confirm. Are you independent? Yes. Will you comply with the code of ethics? Yes. Will you do the consolidation things properly? Yes. Will you give proper disclosure? Yes. So make sure you take the confirmation about code of ethics, independence, and whatever information that you may require for consolidation or disclosure requirements. Now, sir, comes one more point. In case in the audit report of a subsidiary, there is a qualification. In case the audit report of a subsidiary, it is a qualified report. Do I also need to qualify my audit report of consolidated financial statement? The answer is no. The answer is no. Again, in that qualification or modification, you need to consider materiality. Now, sir, when it comes to planning the audit of CFS, first of all, you all understand what is planning. Planning the audit procedure. That is risk assessment procedure, further audit procedure. What is the risk assessment procedure? In which you take the understanding. So first of all, understand the gap. Sir, what do you mean by gap? Group structure and the group wide controls. App for accounting policy. Understand the accounting policy of the entity. Once you are done with the understanding, you will get to know the nature, timing, and extent of audit procedure. And trust me, you don't have to do it all. You can also delegate. You can use the work of other auditor. And when you are using the work of other auditor, coordinate. Do coordinate with him. These are the 5 points you need to consider. Now, sir, as an auditor, how do I ensure completeness of all the subsidiaries, all the associates, and all the joint venture? Just relax. Baby, calm down. Okay. You don't have to take the stress. Let the management take it. So understand the management's process. Understand the management's process of identifying the components. Okay. And ask them, inquire them, whether this year there is an additional component in the consolidation or there is any component that moves out of the consolidation. As an auditor, last year also you did this. So review your previous working papers. 3 points, done, sir. Now, sir, the other points are very simple and logical. How does one component become my component? Sir, how do I get a subsidiary? By investment. So review the investments of the parent. Review the joint venture, joint arrangement, other arrangement. Come on. joint venture, joint arrangement, other arrangement, and similarly you can see the other changes in the shareholding. So these are the basic points that you can see as an auditor. Now there are two types of consolidation adjustment, very easy, permanent and current period. Come on, permanent and current period. What are the permanent consolidation adjustment? Basically your Ind AS 103. These are your Ind AS 103. In Ind AS 103, what do you calculate? NCI and goodwill. Yes, NCI and goodwill are your permanent consolidation adjustment. So as an auditor, you need to focus first of all on the identifiable net assets, or you can say the pre-acquisition reserves of the subsidiary and the date of acquisition. Because on that date of acquisition, whatever are the reserves of the subsidiary, they will get allocated between the parent and the minority. They will get allocated between the parent and the minority, and subsequently, when do you think there will be a change in the NCI? Sir, NCI changes whenever there is a change in the shareholding. So this also you need to see as the auditor. Now, sir, it can happen in one subsidiary, there is a goodwill. In another subsidiary, there is a capital reserve. On the face of balance sheet, can I net off both of them? Answer is yes. You can net off both of them on the face of balance sheet, but in the notes to accounts, you need to separately disclose that goodwill amount. You need to separately disclose that capital reserve amount. Now, sir, coming to the current period consolidation adjustment, we did some pairing. Sir, what was the pairing? First of all, intra-group indebtedness. On that indebtedness, there must be some interest. So, intra-group interest paid or received. Another pairing was what? Transfer of assets. So, if there is an unrealized profit on the transfer of assets, eliminate it. Whenever you eliminate, it leads to a deferred tax. So these 2 points are connected. And the another 2 points were the ones we discussed in the beginning: harmonization of accounting policy and gap conversion adjustment. And the gap conversion adjustment. Plus also remember one thing, sir, what? In case the subsidiaries financial statement, US subsidiaries financial statement are till 31st of December. And the consolidation is done on 31st of March. Is it allowed? Answer is yes. The maximum gap that is between the subsidiaries financial statement and CFS, it could be maximum 6 months as per AS, 3 months as per the Ind AS. Okay. But as an auditor, you need to make sure if there is a significant event between these two dates, it should be properly accounted for. It should be given effect in the CFS. There was a question also in the question bank. Done. Now this point from MCQ point of view. Sir, what is to be disclosed? In the balance sheet, assets minus liability is equal to capital, or you can say net assets. In the P&L, there are two major figures, P&L and OCI. So you need to disclose the net assets, P&L and OCI of all the entities, parent entity, subsidiary, associate, joint venture, all the entities forming part of the CFS, plus their percentage to the total net assets, total P&L and the total OCI, not TCI. Not TCI, not total comprehensive income, that is the total OCI, other comprehensive income. Then we discuss some examples of information which is given in the separate financial statement but need not be given in the CFS. Very easy topic, but still let's do it. So what was this topic all about? First you get money, then you spend. Come on. First you get money, then you spend. That means you get the money by the issue of shares, some free shares, some money shares. So first of all, you talk about the bonus shares. Whenever you issue a bonus share, what was the source of issue of these bonus shares? It could be capitalization of reserve, security premium account, disclose that. Okay. Second thing, when you issued the shares for money, not free like bonus, whenever you issued the shares for money, in case some money is unutilized, what is the form in which that money is kept? What is the form in which it has been invested? Talk about that. Now let's talk about the foreign expenditure. What is the foreign expenditure, sir? Imports on CIF basis, that is cost insurance freight of RCC, raw material, capital goods, and your last point I always forget, raw material, capital goods, and your components and spares. Got that. Components and spares. Got it, sir. Now, sir, out of this imports of goods, you also talk about your expenditure for services. So expenditure in forex for royalty, know-how, technical know-how, or all other services. And then whatever imports you did, talk about its value. Plus also talk about the value of indigenous raw material and the capital goods that you took, and their percentage to the total consumption. Out of the total consumption, how much was imported, how much was indigenous, that is from India. And last point you will forget because it is a micro point. It is about the disclosure of micro, small, medium enterprise, that is MSME Development Act 2006. Very good. Now, sir, we talk about management representation, that is the written representation. These are the same points that are the parent's responsibility, all components, proper consolidation adjustment, Ind AS 24, Ind AS 108, done. Now coming the reporting part, first part is very easy. Parent's auditor is also the auditor of components. So just see whether the PPFS, preparation and presentation of financial statement, is done as per the accounting standard. If there is a deviation, modify your opinion as per SA 705 and then check whether there is a true and fair view of the balance sheet, P&L and cash flow. Come on, balance sheet, P&L and cash flow. Balance sheet, P&L and cash flow. Now comes, sir, whether the parent's auditor, what happens when the parent's auditor is not the auditor of the component? That means it is a different auditor. I have to use the work of other auditor. Whenever you have to use the work of other auditor, which SA gets applicable? SA 600. SA 600, that is O for other auditor. O for other auditor. Then we discuss that if all of us are presenting a report and I just give my name, all your name is removed, how will you feel, sir? We will feel very, very bad. Our name should also be there. So you want me to disclose how much work is done by the other auditor? Yes, sir, disclose. Arey, how will I disclose? Other matter para. Other auditor, other matter para. Other auditor, other matter para, SA 706. So make a reference to the other auditor and tell the amount, magnitude of portion of the financial statement audited by the other auditor. How can I tell this magnitude? Two options are available. First option, give the aggregate amount or mention in percentage terms. Percentage of the total assets, total revenue, total cash flows. Come on, ARC. Total asset, total revenue, total cash flow. One more time, total asset, total revenue, total cash flow. These assets, revenue and cash flow should be before the consolidation adjustment. And at the end of the day, mention to the users that you are not qualifying the report, you are just mentioning about the divided responsibility. Sir, what if the component auditor's report, okay, my component is located in US. My component is located in US and those financial statements are prepared as per US GAAP. That means GAAP conversion needs to be done. Now this GAAP conversion can be done by the component's management and its auditor, or it can be done by the parent entities management and the management. If the component is doing this conversion itself, it must be having a group accounting manual. So check whether the group accounting manual complies with the GAAP applicable to the parent. If they are giving the financial statement as it is, and it is the parent's management which is performing the conversion adjustment, you as an auditor need to audit the conversion adjustment. So two of the possibilities are given. Then in case component is not audited, modify the opinion. The answer is no. The answer is no. You need to consider materiality, that is the qualitative and quantitative factor. So they just write in a proper format. Generally, start like this. Generally the financial statement of all the components included in the CFS should be audited. They should be subject to audit procedure as a part of multi-location group audit. Okay? But sometimes if they are not audited, it could lead to a possible modification. Again, we are not sure. There is a possibility of modification because we have not got sufficient and appropriate evidence. Then evaluate that possibility as per SA 705, considering the materiality, or you can say qualitative and quantitative factors. And just remember one thing, push harder than yesterday if you want a better tomorrow for yourself. Okay? So let's keep on doing hard work, let's keep on working harder, and definitely we will see the results. That's all for today. Keep smiling, keep studying with happiness, because then only we progress. Have an awesome day ahead, and yes, let's catch up in the next class.